US yields and the dollar fell, and gold hit a fresh record after the US jobs data printed a slower than expected wages growth last Friday. Now, attention shifts to the US inflation data this week, which may actually not trigger a similar enthusiasm tomorrow. So, welcome to the new week of trading with Swissquote's daily market talk. Unbelievable! The US economy added 275,000 new non-farm jobs last month, so that was way more than around 200,000 new job additions penciled in by analysts. But don't panic, because happily, the unemployment rate unexpectedly rose to 3.9%, and wages grew slower than expected on a yearly basis and were almost flat on a monthly basis. So that gave a peace of mind to investors. The fact that another strong NFP read did not necessarily translate into higher wages. Phew! So that's basically why the US yields fell and the US dollar index tumbled in the immediate aftermath of that US jobs data, and while the euro dollar spiked to 109.80 level. So while I found that the US dollar sell-off was a bit exaggerated after the jobs data, because while the US economy still added 275,000 new non-farm jobs last month and wages grew 4.3% on a yearly basis, that's more than twice the Fed's inflation target of 2%. Well, Friday's reaction to the jobs data actually revealed a very important information. It is that investors don't care about the strength of the US economy, nor the strength of the labor market. They only care about inflation. And well, because the wages data was lower than expected, the wages growth was lower than expected, well, Friday's jobs data wasn't a disaster for the Fed does. The market still gives around 74% chance for a 25 basis point cut from the Fed this June. So that's where we are right after the jobs data from the US and before the inflation data. So this week, all eyes turn to the US CPI print due tomorrow. The headline inflation in the US is expected to steady near 3.1% level on a yearly basis. Core inflation is expected to have eased from 3.9 to 3.7% on a yearly basis as well. But the monthly figures could print another strong month. And if that's the case, well, we could maybe, but just maybe, see the Fed does retreat a little bit. Because remember, the Fed Chair Jerome Powell said last week that the Federal Reserve can and will start cutting the interest rates this year. But he also said that they are in no rush at all. So this week's inflation numbers could still push the expectation of the first rate cut from the Fed further down the road. The US dollar begins this week on a negative note. The euro dollar actually gave back all of its post-US jobs data gains still, as the European Central Bank Chief Christine Lagarde gave quite a strong signal at her press conference last week that the European Central Bank could take the first step and cut as early as in June this year. Now, pricing in the market suggests that the ECB will cut the interest rates by 100 basis points this year versus around 80 basis point cut expected from the Fed. So, the latter, the negative divergence, dovish divergence from the ECB will certainly limit the euro's upside potential against the dollar into the 110 psychological mark, especially if the inflation numbers from the US this week comes in surprisingly strong, which is actually not impossible, because the gasoline prices jumped in February and the BLS revealed by mistake of last week's. Remember that its new calculation could actually make the inflation numbers in the US look a little higher than otherwise for a few months. So let's see what the data tells, but there is actually a risk of disappointment for the Fed this week and a possibility of a US dollar rebound. Because note that the euro and sterling recorded their best performances against the US dollar in months last week on expectation that the first rate cut from the Federal Reserve won't be delayed beyond June. And gold also hit another record on Friday after the jobs data. The price of an ounce climbed to $21.95 as the market found comfort in the idea that the Fed will cut in June. But if that expectation is kicked down the road, all the recent gains could actually be given back quite quickly. But before I move forward, I think it's worth diving a little bit more into all the gold's recent shine. Released last Friday, the CFTC data actually showed that money managers boosted their long gold positions in the week through March 5th. And that the net long positions in gold jumped 35% from a week earlier. So obviously that could be because these money managers wanted to hedge themselves and their portfolios against the potential post-jobs data market sell-off in the US. So that's one thing. But the other thing is China, because China has been increasing its gold purchases since the beginning of last year, since the beginning of 2023, because the central bank probably, wants to diversify its US dollar holdings, and Chinese people simply want to seek refuge or find refuge amid the property meltdown. Now the question is, could this gold rally extend beyond the $2,200 per ounce? And the answer is yes, it could. And if you look at the inflation-adjusted prices, the inflation-adjusted gold price is below the 2020 peak, which would stand at $2,300 per ounce if adjusted to inflation of today. In 2011, gold traded at $25.81 if adjusted to inflation today. And back in 1980, the price of an ounce went past what would have been equivalent of $3,000 per ounce today. So there is never an upper limit when people want to buy an asset, but any retreat in Fed's rate cut expectations this week could cool down the short-term price surges in the gold market. So voila! Now, if you look into the stock markets in the US, the decline in US yields and the tumbling US dollar didn't really boost appetite in major US indices on Friday. The S&P 500 hit another record but closed the session 0.65% lower, while Nasdaq 100 fell more than 1.5% on Friday. Technology stocks saw their largest weekly outflows on record last week. Now, analysts at Bank of America say that it won't necessarily prevent the US stocks altogether from extending their gains to fresh records, but I think that yes, because I believe that if the euphoria in technology stocks just fades away, we might not see the S&P 493 take the lead and carry this market higher from the actual levels. And elsewhere, inflation in China rose for the first time in 6 months. That was thanks to the Lunar New Year holiday that actually boosted spending in China, but producer prices fell 2.7% over the same month. Still, Chinese stocks kicked off this week on a positive note. Nearby, the Japanese stocks fell as the dollar yen sank below the 147 level on rising speculation that the BOJ could exit the negative phase as soon as this month. Now, I still think that there is more chance of a hint regarding the first rate hike in Japan than a concrete action on the rates front at this month's BOJ meeting. But even a good hint, a strong hint, that the BOJ will hike the rates could help investors rush into long yen positions and pull the dollar yen toward the 140 mark. And finally, in energy, US crude slipped below the 200-day moving average level this Monday, following last week's failure to increase gains above the $80 per barrel psychological level. So this is pretty much it for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.